Number 6 out of 10 in our challenges of market efficiency is called earnings announcement momentum. You're going to see this is piggybacking off of the momentum conversation that we had 2 videos ago. And this happens when an earnings announcement each quarter, when companies report earnings, if they have an abnormally positive or abnormally negative earnings announcement, which is above expectations or below expectations, we see some mispricing. And so let's talk about that here for just a moment. That what we find here is there's an overreaction to these announcements. So we find abnormal, positive, and negative returns after an abnormally positive and negative earnings announcement. Positive, negative return after an abnormally positive or negative announcement. And we can define this. It's been done in a couple of different ways. Abnormally positive quantitatively would be either 25 or 25 or 50% higher than the expectation. And that would cause this, put it in our data set. And what we find though, is if there's a positive announcement, we see abnormally positive returns. Now, this is interesting because these positive and negative returns persist right over here. I'm going to put an asterisk because these returns persist for several weeks and sometimes even months. And once again, we're having this conversation because we're challenging market efficiency. And some of the assumptions that we talked about for market efficiency is that everybody reacts in the same way to new news. So that means if there's an earnings announcement, everybody absorbs that no matter how good or how bad it is. Everybody absorbs that information and then reprices. And there shouldn't be any disagreement in how we reprice this. But what these findings are indicating is that there is a lot of emotional reaction to this. And so if people are reacting positively to the positive earnings announcement, there's an overreaction on the positive side. So overreaction in both directions. And this overreaction happens for several weeks and sometimes even months. And this is also on the negative side. If there's something really bad, it takes a long time for people there's an overreaction on a negative side. So it goes down and has really abnormally negative returns for the next several weeks or months. And so I'm looking at this earnings announcement going, all right, if this is truly happening, and now we know how to define it, whether it's 25 or 50% off of what we were indicating here, if we're going to play this, then we can actually, I'm looking at the positive announcement. And as soon as that announcement hits, that means I want to buy at announcement as soon as possible. Because the theory stands that it's going to remain abnormally positive from a return standpoint for the next several weeks or even months. From a negative standpoint, let's think about this one. What would you do if there's a negative earnings announcement? So my instinct sometimes would be I want to, as soon as it hits, I want to buy it right on the bad news. But what these results indicate is that people are going to overreact negatively. So there's going to be a long swing, several weeks or months, that it's going to have abnormally poor returns. And so I'm waiting for that to hit the bottom and start to level itself out. And then towards the end of this several weeks, I'm going to start buying it up, thinking it's going to go back to its fundamental price once that negative overreaction has flushed itself out. So we're going to wait on this one and look to buy these stocks in several weeks. But we want to try to find it at its lowest point so we can use technical analysis, maybe some charts in order to figure out when that is going to end. So that is earnings announcement momentum. Nice piggyback off of what we were looking at in our overall momentum assessment. And that is number 6. So 4 more to go. You're almost there. Let me know if you have any questions. Talk to you later. Bye.